Okay, let's dive into this. I mean, how exactly do you afford a massive $250,000 excavator without completely draining your vital working cash? Or let's say you're opening a restaurant. You need top-tier commercial kitchen gear, but you've got to keep money on hand for payroll and inventory, right? Well, welcome to our explainer on the ultimate playbook to Canadian commercial equipment financing. We're going to completely decode the often confusing world of lenders, rates, and leases so you can equip your business for success without breaking the bank. To really grasp the sheer scale of the equipment needs we're talking about in Canada, just take a look at this number. The Canadian food service industry alone does $100 billion in annual sales. That's massive. And across construction, agriculture, and transportation, operators are pouring literally billions into heavy machinery. It's a colossal market. And because it's so huge, there are countless ways to finance your gear. Some of them are absolutely brilliant, and some, well, they'll cost you dearly if you aren't paying attention.
So here's our structured insider's playbook roadmap to demystify this opaque world. First up, we'll tackle the cash flow dilemma, then move right into finding your lender match. After that, we'll hit the big lease or buy question, expose some hidden fees, weigh new versus used equipment, and finally wrap it all up with a smart shopper's playbook.
All right, let's kick things off with Section 1, the cash flow dilemma.
And this brilliantly illustrates the core problem facing literally every single operator out there. It's the ultimate balancing act. You have this desperate, urgent need for reliable equipment, but you absolutely must preserve your vital cash for daily operations, emergencies, and, actual growth. On one side, you've got high-cost assets. A heavy excavator can easily run you upwards of $250,000. You just can't pay cash for that without taking a massive hit to your liquidity. But on the other side, targeted equipment brings incredible returns. Think about a commercial soft-serve machine. That thing can generate an astonishing 70 to 80% gross profit. Financing is the magic key that lets you acquire those high-margin machines and literally pay for them using the brand new revenue they generate.
Moving right along to Section 2, finding your lender match. A lot of business owners think they can just Google the absolute lowest rate and demand it from their bank. But the reality, that lowest rate isn't always available to everyone. Your specific credit profile and time in business really dictate which lender tier you actually belong in. So let's break down the 4 distinct lender tiers. You've got the big banks and credit unions up top. They offer fantastic rates, as low as 6.5%, but they move at a snail's pace, taking 2 to 4 weeks, and they only approve pristine files. In the middle, you have equipment finance companies. These guys move in days and are definitely a bit more forgiving. And down at the bottom, private lenders. Yeah, they charge up to 22%, but here's the kicker. They will approve really challenging, complex files in as little as 48 hours.
So the big question is, where do you sit? This breakdown shows exactly what your credit score actually unlocks. If you're sitting pretty on an excellent 750+ score, you're walking straight into the bank and getting their very best rates. But if your score drops down into the fair or challenged range, let's say you've got a 580 subprime score, the harsh reality is the bank won't even entertain the conversation. They're just going to decline you. Knowing your tier right off the bat saves you so much time and prevents the credit hit of applying to the completely wrong lender.
Which brings us to Section 3, lease or buy.
Okay, this is where we really have to look at the structural implications of how you finance. Do you borrow money to buy the equipment outright, or do you lease it? Because both paths have entirely different impacts on your balance sheet and your taxes. But just take a look at this absolute wall of math for a second. Yeah, unless you genuinely want to spend your entire weekend calculating these mind-numbing 1993 Ivy Business School net present value tax formulas to figure out your deductions, we're definitely going to need a much, much simpler way to look at leasing options.
So let's distill those incredibly complex rules down to this super simple contrast. You essentially have 2 main choices here. A $1 buyout lease acts exactly like a loan. You're going to have a higher monthly payment, but you own the machine outright for a single dollar at the end of the term. On the flip side, a fair market value, or FMV lease, gives you the absolute lowest possible monthly payment. Why? Because you're only financing the depreciation of the equipment while you actually use it, and at the end, you can either buy it at market value or just toss the keys back and return it.
All right, Section 4, beware the hidden fees. Okay, it's time to put on our detective hats for a second, because this right here is where the fine print can absolutely destroy your budget. We really need to expose how some lenders manipulate the numbers to make a deal look way, way better than it actually is. So the crucial point is understanding the fundamental difference between these 2 rates. The stated rate is just your base interest percentage. It looks phenomenal on a billboard, but the APR, the annual percentage rate, is that stated rate plus all the hidden fees and costs rolled into one single annualized number. Comparing the APR against the stated rate is literally the only real way to find out what the loan is actually going to cost your business.
And what exactly are these hidden fees that sneakily inflate your true cost of borrowing? Let's do a rapid-fire rundown. You've got to watch out for documentation or origination fees. Those can hit you for up to $1,500 right out of the gate. Then there are appraisal fees, broker fees, and absolutely brutal prepayment penalties if you try to do the right thing and pay off your loan early. Oh, and don't forget force-placed insurance charges. Add all these up and they can turn a so-called cheap 8% stated rate into a very, very expensive reality.
But, context is everything here. Because sometimes, as this quote perfectly points out, speed matters more than savings. Think about it. Let's say you just won a massive contract, but you absolutely need a machine on site by next week. Taking a higher 12% rate from a private lender just to get that machine working and generating revenue in 5 days is often so much more profitable than waiting 5 agonizing weeks for an 8% bank loan while your entire project just stalls out.
Let's jump into Section 5, New versus Used Equipment. Now, we need to shift gears a bit and look at how the physical machinery itself, specifically its age, overall condition, and working hours, directly impacts the risk profile for the lender, and therefore the rate that you end up paying. Brand new equipment, it gets the baseline rates because it has a shiny new warranty and a totally predictable value. But check out the 3 to 7 year sweet spot. Picking up something like a 2019 Cat D6 dozer or 2021 Bobcat S650 offers phenomenal value. You're only paying a slightly higher interest rate premium, but you completely skip that massive, painful initial depreciation hit of buying brand new.
And this right here is exactly why. Buying certified used equipment drastically lowers the actual amount you need to finance. For example, grabbing a refurbished Henny Penny pressure fryer for your commercial kitchen lowers your monthly loan payment significantly. But the best part? That machine still delivers the exact same massive return on investment as a brand new one. Less debt, exact same profit. It's a total win-win. Which brings us to our final section, Section 6, the Smart Shopper's Playbook.
Now, what's really interesting about this slide is how we bring all this complex information together into an actionable, step-by-step strategy to secure the absolute best deal for your business. First up, pull your own credit report before you do anything else so there are 0 surprises. Second, and guys, this is absolutely critical, do all your rate shopping bunched into a tight 2 to 3 week window. This heavily protects your credit score from taking a beating from multiple hard inquiries, because the credit bureaus will just count them as a single shopping event. Third, always demand the APR and those itemized fees. And fourth, use competing offers to aggressively negotiate your total out-of-pocket cost.
And while you're negotiating, remember to explore these really powerful alternative pathways. The Canada Small Business Financing Program, or CSBFP, allows the government to actually share the lender risk, offering up to $500,000 just for equipment. Or look into BDC loans. These can incredibly cover up to 125% of your purchase price, which is amazing because it helps you roll in the extra cost of shipping, installation, and training. And hey, never ignore manufacturer promotional rates. If your credit is stellar, those can drop all the way down to 0%.
Which brings us to our final thought. You already know the incredible potential of your business. You know exactly what that new equipment could do for your bottom line. But do you really know your true financing profile? It's time to take control. Identify your tier, keep a sharp eye out for those hidden fees, and aggressively seek out the perfect financial match to fuel your growth. Thanks so much for joining us for this explainer, and we'll see you next time.